Guy, it's good to have you. Pretty wonky but consequential debate. A lot of people trying to figure out what's really going on here. What do you say?
Yeah, it is hard to figure out. It's a little bit in the weeds. It's the kind of thing that mortgage lenders normally track, but not anybody else. But, the bottom line is some borrowers who have high credit scores are going to be paying slightly more, and some borrowers with low credit scores are going to be paying slightly less.
So let me ask you this. I get the idea to make the housing market more equitable, more accessible, more available to people. But to the extent that you make loans more available to individuals who are shakier credits, are you inviting a possible sort of replay of the subprime crisis of 15 years ago?
I don't think I'd go that far. We're certainly increasing the risk. Two of the biggest factors over the years that have determined credit risk or the likelihood of a mortgage default are no equity or high loan-to-value ratios and low credit scores. So to the extent you mix those two, you're certainly encouraging more risk. All these loans that we're talking about also carry private mortgage insurance. So to some extent, that is meant to offset the risk to Fannie Mae and Freddie Mac.
Is it true what Diana said, that high-income borrowers still pay more than lower-income ones?
Higher income borrowers are going to pay a slightly higher fee than they were in the past. But the difference is if you've got a low credit score, let's say 660, compared to someone with 760 and the comparable loan to value ratios, you're going to pay 3 times as much with that lower credit score.
So the lower credit score individual still pays more than the apples to apples on a similar size loan than a high credit score individual. But the high credit score individual is going to be paying higher fees, and the low credit score individual is going to be paying lower fees, right?
Exactly.
Okay.
It's, marginally different. It's not a huge increase, but that's basically it. And it's, a goal is to make Fannie Mae and Freddie Mac's loans more accessible to lower income and minority borrowers, and this is one way to do that.
Yeah. You said this was in the weeds. I got poison ivy now, Kelly.
I was going to ask about a 40-year mortgage. I mean, we've seen innovations like these discussed, and would something like that be more straightforward? Are there other ways of achieving these goals, or why do people think that this one in particular is useful when it's hard to understand, sort of small potatoes around the cost of owning a home? Why this fix when are there other fixes out there?
Well, it is unusual to see something like this. Traditionally, we've seen Fannie and Freddie have special programs targeted at lower income borrowers or people with lower credit scores. And there's an education function and there's a specific application, but it's outside the mainstream. This is one of the first attempts we've seen that's really mainstreaming the underwriting to bring in lower income and minority borrowers.